G'day everyone, welcome back to another episode of the Australian Property Investment Podcast. I'm your host, Aaron Christie David, and I run a mortgage broking business called Atelier Wealth. The goal behind me setting up this podcast was very much to try and get in front of as many top industry leaders as I could to then share that knowledge with a lot of our investors, because we specialize in helping Australian investors start out and scale up their property portfolios. One of the challenges that we found when people start to scale up is they usually hit a wall, and sometimes the wall isn't borrowing capacity related, nor is it equity related. Sometimes it's emotionally related, and often that stems around fear, the fear if things go wrong or the fear if they buy the wrong property. And that leads into a very, very different conversation, because we're taught that investing should be very rational and the numbers should make sense. But our guest today is going to blow that wide open, and I'm really, really excited to bring on Luke Harris from the Property Mentors. Welcome to the show, Luke.
Thanks, Aaron.
Absolute pleasure to have you here. And I guess the beauty for us connecting is I like what you stand for. I like that you take a somewhat different position in the market, because there's plenty of buyers agents out there. There's plenty of wealth creators out there, for example, but you kind of position yourself really, really neatly in the market as a property mentor. And I feel like that's a unique position, but it's a very powerful one to take for a lot of new and experienced investors alike as well, right?
Yeah, that's right. There's a lot of people, I guess, out there in the property industry, and there's a lot of different types of businesses out there, and I think that we fill quite an interesting little niche in the property market.
Well done, mate. Luke, before we kick off, I'd like to ask all our guests, a bit about the 3 Ps, and to share a little bit about personally your story, a bit about your professional journey as well with creating and launching your business. And there's some really great achievements, i.e. books that you've got under your belt as well. But then also a little bit about your own property journey, because I know you lived and breathed this. If you'd like to share with us a little bit about your journey, that'd be great, mate.
Yeah, for sure. So look, I started from a very young age in property. As soon as I got my driver's license, I was out looking at beautiful big homes all around Perth, and sort of dream building, as they called it. From age 19, I started my first business in Perth. I realised that I wasn't going to be a very good employee. And from age 20, I bought my first property and started renovating. So yeah, very young start. And I really wanted to get my teeth stuck into the business world and the investing world. I had some people that I looked up to. I had a wealthy uncle and a few other people that I'd seen do really well. And I realised that school wasn't for me. Yeah. University wasn't for me. And if anyone was going to build wealth, no one's going to do it for you. You've got to get out there and do it on your own.
Mate, well said. Perfect. And then that's now translated. So I guess the fire in the belly was there at a young age, going, look, I've seen wealthy people and assets create that, for example. Then take me through like your journey into launching the Property Mentors and how that came about, mate.
Yeah, so look, during my 20s, I had gone out there and done what a lot of investors typically do. They go out there and buy a property and maybe do a renovation or maybe a small subdivision, maybe buy off the plan, buy in a mining town for cash flow, all of these different buzzwords that people speak of, and all of the different the hot topics in the property industry about how you should invest. And as a young 20-something, I was out there like a lot of people, trying to really navigate through all of the media and the noise and the books and articles and everything that's out there. So much information. And I did what a lot of people do, and I just jumped from strategy to strategy because I thought that if I've got a house, well, now I need an apartment. So I went and did that. And then after that, I went and bought in a mining town because apparently you need positive cash flow. So I did that. Then I bought a development site and did a subdivision. And then I bought off the plan. I kind of did all of these different strategies. But during my 20s, it was very much a zigzag approach. There was no real plan behind it. It was just, this is where I'm at. My broker said I can do this, as in how much I can borrow. And then I went and did something with that amount of money. And what I was doing, like I said, for a lot of people is they're trying to navigate with the information that they've got at hand and really putting your toes in the water every time you're going out there and buying a property, because there is no real plan to link it back to. And so going through that process, I did that through my 20s and got to my 30s. I turned 30 and took an 18-month mini retirement.
Well done.
I didn't know it was going to be a mini retirement at the time, because I figured, well, I sold my business, my electronic security business, and did some traveling. But after that, I really sort of assessed what I was going to do next. And sitting on the beach every day, and I literally had a house right on the beach. You could walk out on the sand from the backyard. It was amazing. The dog and the cat chasing each other around on the sand dunes. It was a lot of fun here in Melbourne. And having a beachfront property literally was spending time on the beach every day. And after a while, I realized, well, I want to do property. I want to do full time. How do I do that? And so what I started doing was really dissecting the property investment space, looking at all of the gurus out there, all the books. I'd read dozens and dozens of books, if not hundreds of books over the last few years, and really started to look at what works and what doesn't work. And there was a lot of things that don't work so well in the property industry. And there's a lot of sharks and cowboys out there, and I'm sure you're well aware. Not here to name names, but there are a lot of people out there in the property industry that don't necessarily have that long-term view with their customers. And really, that's where the Property Mentors was born, in the early 30s, I would say, for me. And we started in 2014. And have been doing really well since. But the whole business was established to provide a genuine service that mentors and guides people through their property journey rather than just flogging a property. Yeah. And that's where a lot of the property industry is very good at selling properties, but not much of the property investment space is targeted towards genuinely understanding the investor's long-term needs, what their goals are, and then linking back the property plan to that end goal.
You're right.
But that was where the business...
Something you just mentioned there, which I find relevant, is sometimes they don't know. So we go, look, they just want to buy a property. And there's nothing wrong with that, right? But it's like, well, what are we looking to get towards? Like, I don't know, we'll just see how this goes. And so sometimes investors, so newish investors, need to be led a little bit. So they need that leadership rather than being sold a property, for example. And that's not the outcome. It's, okay, so what are we looking to do long term? But sometimes you're working with a brief that isn't clear either, right? I'm probably sure that you get that from time to time as well.
Yeah, I think different to a buyer's agent, where a buyer's agent will be given a list. I need a 4-bedroom
criteria.
house with a pool.
Yeah.
Yep. And, go and find that for me. And this is what we've found. And again, looking back at my own personal journey, I didn't know what I was doing. And so I can't be expected to tell people, go and do what you want to do and hope it all works out. If we identify up front that there's multiple components to investing successfully, property is just one part of that.
Absolutely. Maybe when we had a chat the other day, I was, obviously we've got an election coming up, for example, and time will tell how that will all play out. But we always have these interesting periods pre-election where the market just kind of sits and waits, a little bit like caretaker mode for government employees, for example. But from your experience, what is this time? How are you kind of reframing this time for a lot of your clients, all those conversations that you're having versus pre-election versus post, for example, as well?
Yeah, I think this is something that we've all lived through before. It does, like you said, go into a bit of a caretaker mode where people are sort of sitting on the sidelines. I've found over the years the people that can deal with the most uncertainty seem to make the most amount of money when it comes to investing. So a lot of people that do decide from around now or even March or April, a lot of people decided to just wait and see what policies are coming out, and then they wait for 6 months after the election to see if the new government, whatever it looks like, follows through with what they promised. So a lot of people will sit on, almost take 12 months off investing, and a lot of people, to link that back to an example, when COVID started, early 2020, a lot of people thought the whole world's about to implode, property prices are going to crash through the floor, let's not do anything. And some of my best purchases for myself, I bought 9 properties during 2020, and those 9 properties have all increased in value, have bought extremely well because there was no competition at the time.
Yeah.
And so it's a very interesting thing for people to look at one side of it. I want to sit on the sidelines and wait for the election to be over. And then those that are going to take advantage of the opportunity with less buyers in the market. And it might only be a small percentage that are less, but there is certainly going to be people that will sit on the sidelines. So I don't think we should get into a political conversation necessarily, but I think that, I think either way, the property investing seems to be, to a certain extent, pushed to the side for this election, whereas the previous election, Labor had their policies around negative gearing and wanting to scrap that. And that did cause a lot more people to sit on the sidelines.
Yeah,
so probably not as many will sit on the sidelines this time around. But of course, now we've got that looming interest rate rise and higher inflation that's now sort of hanging over our heads as well. So a lot of people are a little bit nervous about that as well.
Yeah, absolutely. Yeah, it's to be tone deaf to not acknowledge that and go, right, yeah, these are real life examples for like people where they're feeling squeezed, for example, and a rate rise may push a little bit of disposable income back out, for example. But we also know that we had to get to this stage at some point. It was going to go up. So people have been stress tested and means tested, but there's a different reality when it happens as well, isn't it? When we had a chat again, I'll talk about you guys and the tag being property mentors, because we see wealth coaches, we see life coaches, we see buyer's agents. And again, I'll say that you guys are uniquely positioned. So again, clients will go buy purely on the numbers, sight unseen. You don't have to like get emotionally attached to it. Whereas I can speak firsthand. I think this is highly emotionally charged. Quite often it can be a couple scenario. So, trying to get one couple on board when the other one's bullish and the other one's bearish, for example, or one's happy to take a risk and the other's like, well, let's just pay our home off. And I don't use the word just lightly, but it's like, well, let's do this rather than that. And so it feels like one or the other. How do you then kind of, manage that with your clients and go, look, I can understand the fears, I can understand what's holding you back, and I can understand where you need to get to, but we need to take some type of action. And how do you lead them on that journey, mate?
Yeah, so in my first book, Let's Get Real, I talked about the different processes that we have to go through. And one of the first things we work out is the 3 Ds, I called it, which was the dream, the date, and the dollars. Right? We need to identify what it is we want to achieve, the date that we want to achieve it, and the amount of dollars that we need to actually achieve that goal. And it's a lot easier to really have that conversation about getting both parties on the same page when you understand the goals. Because without those goals, then if you've got one person that's a little bit, scared of taking risks, and you've got someone that's a little bit more aggressive with their risk profile, getting them back on the same page is only going to work once you've identified the goal and the reasons why they're doing it. And I guess from our process that we have here at the Property Mentors, as highlighted in my recent book, Property Fit, we talk about the 3 different stages of readiness. Now, one of those, the first one that we need to do is talk about the financial readiness. So, of course, having money to invest is a good start, but also understanding your finances, understanding your borrowing capacity and what the banks will lend you. That's the first stage. You need to understand your financial readiness, how ready you are. Yeah. And then, of course, we need to talk about the educational readiness. So where's your education level? How much do you know and understand about property investing in general? Do you understand tax depreciation and companies and trust structures and the things that you need to learn about, not necessarily to adopt in your own portfolio, but to understand what investing really consists of. And then, of course, you've got your emotional readiness, which ties into that as well. And that's the bit that trips a lot of people up. And it's understanding your emotions around where you're worried, where you're concerned. Yeah. Maybe you're taking unnecessary risks. Your emotional readiness could mean that you're just gung-ho, you want to get in the market. I coined a term a few years back called it's a ban mentality. It's a buy anything now. Right? And that's where you just sidestep anything educational or emotional readiness. You want to get in the market because you think you're going to miss out. And that's scary for a lot of people. So once you understand the emotional side of it, you can understand what's actually driving any fear that you've got. And often for a lot of people, it's that overconfidence. So if it's a bit of fear about interest rates or the government, or the election, could be about property prices, interest rates, market crash, all of these sorts of things that people could be worried about. We've got to assess those things piece by piece and understand what's the real risk of those things happening. Yeah. And then just putting it all into context, because a lot of people will have a perceived risk of something, say interest rates, for example, and they hear talk of the interest rates are going up. So that stops them in their tracks because they're worried about interest rates going up. Yeah. But when you do the numbers on the investment, it might be as little as $70 a month or $50 a month. Now, I know that's not a small amount of money. For some people, that might mean the difference. But until you actually understand that number and what the exact number is, then all you're doing is just worrying about something that doesn't have any substance to it.
Spot on. We've done this person with our team, for example, which is Tim Ferriss came up with it, which is the fear setting exercise. So a lot of times we'll do goal setting. So you go, look, here's what I want to get to revenue, for example. Here's what I want to get to sales or settlements or a certain savings target. But to get there means you need to break through a barrier, and quite often that barrier is fear, because confidence or I guess a positive sentiment will only get us so far, but it's like the fear will then hold us back. So if you kind of put all your fears onto a page and you go, right, what's the likelihood, just like what you mentioned, what's the likelihood of this eventuating, or is this a logical fear or just something I've built with, or does this come down from a parent or a past experience, versus, okay, I've addressed the fear. And for an investor, it might be the tenant damaging the property, rate rise, like you mentioned, for example, being out without a tenant. Okay, great. Let's talk about that. If your tenant damages the property, there's insurance for that. If you're without a tenant, okay, let's drop the rent, get someone in there, and then eventually you can maybe bump the rent back up in 6-12 months' time. But yeah, I think what you've done there is to be able to articulate that just almost goes, you hear me, we've been able to put this pen to paper, and okay, now we can get past it rather than suppressing it, go just buy the property and not pay any homage to that as well.
I think the reason why we take this approach, and just to probably give a better understanding of why the property mentors exist, is because so many people will go out there and buy a property and sell it within the first few years.
Yeah.
And the reason that happens, and the reason why most people aren't successful property investors, even people that buy a property and maybe have 2 or 3 properties, they end up selling down that portfolio because their circumstances change. And the reason why that happens is because their circumstances change, but they never had a plan to keep the portfolio.
Yeah.
And if they understood why those properties were so crucial to their long-term success, they wouldn't have sold the properties. But I imagine if you go out there on the street and you interview, 10 or 20 people in their 60s, ask them about property, you ever owned an investment property, I'd say a lot of them will turn around and say, I had a property 20 years ago, I wish I'd kept it.
That's exactly it.
And I think that's
spot on.
The challenge. So the reason that property mentor property and hope for the best, but to really replace their income and really set themselves up. So when we're going through, if you want to be a professional at anything, right, you want to become a professional tennis player or a lawyer or an accountant, if you want to be a professional at anything, there's a lot of work to do. And when it comes to being a professional property investor, understanding your emotions, understanding the education that you need, understanding how the whole investment plan is going to work for you, that takes work, and it takes a bit of energy and it takes a bit of guts to actually get out of your comfort zone. And when we're going through this process, that's not right for everybody. Some people do not want to get out of their comfort zone. They don't want to address their fears, like you mentioned before, and they don't want to break down those fears and barriers that are stopping them. It's uncomfortable and it's not easy, but it's very simple when you understand how it works.
You're certainly right. And I'll go back to your point that you said you bought 9 properties, and this is certainly no way insulting to you. We go, hey, if Luke can do it, then I could do it, right? Like, we're no different. And it's not, Luke, you could change up with another person that bought a few properties and someone else, like the accidental investor who just bought and got, I won't say lucky, but you have to create your own luck. So you're in the market, but then they go, well, if they can do it, I can do it too. Just research, and I'll go and buy a property, and again I go. And so you're right. They can copy and replicate, but to be elite or to be top tier, and we talk about, say, 1% of investors own 6 or more properties when the goal and ambitions was always there. It's like, well, the 1%ers are the elite ones that are doing something different, that have invested in their time, invested in their team as well.
Well, that's it. The whole process of buying a property is not difficult. If you're able to sign your own name and draw some deposits out of your bank account, you can buy a property. Okay. Now, that doesn't mean that you've got the right tax structures in place, that you've purchased under the right entity. Have you considered your land tax liability, not just now, but in 10 or 20 years' time? All of these different components. So buying a property is the easy bit. The hard part is all of the preparation before that. In our process, the last thing we do is buy the property.
Yeah.
Whereas a lot of the time people will go out there, speak to their broker or bank, they'll go and buy a property, and then they work out, okay, what are we going to do with it? And how's it all going to work? So if you're doing it the wrong way around, that's where you could find yourself under financial pressure. Yeah. And that's where people sell down their portfolio and don't end up with the long-term success. And this is why it's so crucial to understand why you're investing in the first place, but also understand how each property fits into the strategy. And I look at it like a jigsaw puzzle, right? You've got to have the box. You've got to know what's on the cover. You've got to know what you're building. If I gave you a whole bunch of jigsaw puzzles pieces, how would you know what you're building if you don't know? And you're trying to squeeze different pieces in and you don't know whether it fits or not. And so this is the problem with a lot of investors is they go out there and buy a property, put the second one in, put the third one in, and they're trying to make it all fit, but they don't actually understand how it's going to reach that medium to long-term goal. And that's really why it's so important to understand those parts of it. And yes, like you said, it is easy. Go and buy a bunch of properties and hopefully it works out. I've worked with a number of people over the years, specifically a lady in Sydney who was on a high income, early 2000s, and their accountant said, you're paying too much tax, go and buy some investment properties.
Yeah.
And they bought 3 or 4 properties in Sydney. And as you can imagine, early 2000s, very quiet market in Sydney. She's now got a $15 million property portfolio. And that was literally by accident because they were both earning $450,000 a year each. And they were just paying huge amounts of tax. And the accountant just said, go and buy some properties. That doesn't happen very often.
Correct. But we hear about those stories because they're great stories to sell, but they're not the reality for most investors.
Yeah.
Perfect. And going, I guess, to double down on your point, so you talk about the jigsaw puzzle and what are people doing and why they're doing it. So buying for the sake of it isn't right, but investors will usually buy for maybe up to 3 reasons. It's cash flow, capital growth, or maybe some upside opportunity, say a renovation or subdivision opportunity, for example. So when you're talking to your clients, and again, this will be on a very case-by-case basis, but what's your ethos when it comes to investing? And you're saying, look, cash flow is good, but capital growth is greater. Like, what's your outlook?
Well, I don't like the whole concept of saying you should sit in one camp or the other. Investing shouldn't be for cash flow or for capital growth. It should be for both.
Yeah.
At different stages in your portfolio, you're going to need different things. So when you're starting out, if you're on a relatively low income, you might need a higher cash flow property. And it might mean slightly subdued capital growth for the first little while until you can catch up with rents and the market catches up. There's also investors out there that are earning a really solid 6-figure income, and the cash flow side of the property, an extra $30 a week is not really why they're investing, right? They're investing to help their tax situation and for capital growth, so they can afford to hold on to more properties as they build the portfolio.
Yeah.
We've got a gentleman that we work with. He's got his own business, and he's buying a property at the moment every 6 or 7 months because he can keep coming up with deposits.
Yeah,
and his cash flow is very good. So he's working in conjunction with his accountant. We're structuring the portfolio so that every property, we assess the numbers and how it affects the rest of the portfolio so that he can continue to grow the portfolio. And like a lot of people, if you want to delve into the dark parts of the internet on property investment forums, where everybody's an expert, you can go in there and a lot of people, have an opinion on buying positive cash flow only or this or that. But and the biggest problem that you see in a lot of the investor world out there in Australia is that people get to 3 or 4 properties, they get stuck. And the banks won't lend them any more money. And if you're in that situation, it's because the property portfolio wasn't structured the right way in the first place. And it was never built with the intention of continuing to buy.
Yeah, correct.
And if you're in that situation, often you'll go speak to the broker, you'll get frustrated.
Yep.
And I got in this situation in my 20s. The bank said no more. And I said, what do I need to do I need to go and buy some more property. And I thought the only way to do that was to do some developments. And so people try and look for other ways of doing things because they want it to go faster.
Yeah.
And if you plan it the right way, you can continuously buy and structure yourself the right way.
Beautiful, mate. Thanks very much. I mean, we're privileged to speak to quite a number of I call them authority figures, but quite a lot of people that have become published authors, and you're privileged enough to have written 2 books. So again, I say writing a book, labour of love, for example, it means that you kind of put your heart and soul into a project, and really fortunate. Obviously, your book has hit the mark that you've been picked up by a really great publisher as well. So, mate, kudos to you. Take me through the book Property Fit and a little bit about, I guess, your philosophy that went into that, the reason you wrote it, and also what someone would expect, as they read through the pages, what's some of the messages that you're really trying to communicate out there as well, mate?
Yeah, for sure. So the Property Fit was actually written and ready to be published early in 2020. And obviously with COVID happening, we had to
pick a time and a place.
tear out half the book and rewrite it. But essentially the feedback that I got from my first book, Let's Get Real was really focused around understanding why. Right. Okay. And the subtitle for Let's Get Real was the real reason why most property investors don't get the results that they desire. And that was really to highlight the starting point for most investors is that they should understand why most investors fail, first of all.
Yep.
What you need to do to change that, right? Because you only get one shot you're only on this planet one time. Yeah. Right? We think we're here forever, but life goes very fast. Your 20s are over like that. Your 30s are over like that. And I'm in my 40s now, so I'm sure that'll be over in no time. But the thing is, you only get one chance. You might as well do it properly. And my dad taught me this from a really young age. If you're going to do something, do it properly, right? And I think he was referring to lawn mowing and jobs around the house and things like that. So that
which I took the ethos is if you do a job terribly, they just won't ask you again. So I did the lawn really bad, and I never got asked to do it again.
That's another way to look at it. So I think going through Let's Get Real was really getting people to understand the big picture. And then from there, the feedback from Let's Get Real was great. Now I understand all of that. What property should I buy? And that's always the next question. People go, well, I want to invest in property. Where do I buy? Where's the best place to buy? And I still have friends and family come up to me. I get messages on LinkedIn all the time. Hey, Luke, saw your profile. Where's the best place to buy? And I literally had a friend a couple of months ago saying to me, hey, I've got some money. I've spoken to my broker. Where's the best place to buy?
Yeah.
The best place to buy is where it suits your strategy. And first of all, if you don't have the strategy, we need to understand what that is. So Property Fit really is designed to teach people about which property is going to fit into the portfolio. But it's also got a bit of a fitness reference to it as well, of course, in that you want a healthy, fit portfolio. You don't want something that's sitting on the couch eating chips and Coke every day, watching reruns of Oprah, right? You want an active portfolio that's going to be it. So really the Property Fit book delves into all of the different common strategies, such as doing renovations, flipping properties, doing rooming houses or short stay accommodation, buying off the plan, buying established property. And there's all these different strategies that people try, and also understanding positively geared property and negatively geared property. Because a lot of people assume that the gearing of a property is the property itself. Yeah. And I think Property Fit talks about, the fact that you can't drive down the street and point out a positively geared property or a negatively geared property. And some properties might start out negatively geared, but they become positively geared.
Spot on.
So I think a lot of people don't truly understand it. And funny enough, it's one of the most talked about things, positively geared property, negatively geared property. And in the media, all you need to do is jump on any Facebook page every time the media posts something about negative gearing. Read all of the comments in there if you're crazy enough to do that. Yeah. Because people don't understand what negative gearing is. And I think an explanation in Property Fit for people to really understand what it is. If I put a 50% deposit down on a property, then it's probably going to be positively geared.
Correct.
But if I borrow 90% of that from the bank, it might become negatively geared.
Yeah.
But over time, the rents are going to go up and the debt's going to come down. So it's just understanding that. So the book sort of delves into all of these different strategies that people commonly talk about. And then it gives people the positives and negatives. So people get an understanding of all of these different things that are available to them, and allows them to really understand how these things could potentially fit into their portfolio. A lot of people come to me saying, look, I want to do a development or I want to do a subdivision. And it's also understanding how that's going to fit into your life. Yeah. Because that takes a lot of time. I've done a number of developments, and I'm doing a land subdivision at the moment up in Queensland. It takes a lot of time, and it's a lot of your spare time. There's a lot of the stuff that contracts need to be read. You've got to go to council meetings. You've got to do all sorts of fun things, dealing with the lawyers, all of that stuff that has to happen over and above.
Great. And a lot of people look at investing going, oh, this is a passive income. But I'm like, hang on, actually, this is very hands-on, very active. So be very careful about if it's passive or active, right? It's a very, very clear distinction between them. And I love the fitness analogy, because quite often I say to clients, which is, if you're training for a marathon, it's very different to training like a sprinter. Everything about your body type, everything about your fitness, your diet, the specific type of training you're going to be doing is very different based on what outcome you're looking for. And so again, if your book has that fitness analogy to it, you got to train for the right outcome that you're looking for.
Well, that's it. And my dad was a marathon runner, funny enough. Yeah. And my younger years were spent getting up Sunday mornings with mum and my little brothers and sister going to watch dad run. Awesome. And he won the Perth Marathon a number of times. And he flew over to Osaka and did a marathon over there, sponsored to do that. So understood watching him doing his training, and he would be running all the time. And just to watch his commitment to that end result. So it wasn't really an active training for me, but subconsciously I saw it, get up, train, eating healthy, training. And it's that mindset saying that if I keep going and stick to that goal, I'm going to achieve it. And that's why he won the Perth Marathon a number of times. The shorter stuff, the 10K, 15K runs weren't his thing. Yeah. I know that he did really well in them, but the long distance stuff, I've still never done a marathon. I'm sure I should at some point just to show him that I can. But I think that diligence really that I saw from a very young age, and that sort of life lessons that you get about, if you're going to do something, do it right the first time. And it's those things that really ingrained into me.
Mate, well said. It's also the company you keep. I'm sure your dad was hanging out with the leaders of the pack as opposed to the people at the very end. And quite often, see investors hanging out with people and it's like investing's a bad idea or it's not that great. And so they're being fed that almost that influence versus your dad's around like-minded people who are at the top of their game, they're winners and they're turning up to win and, competitive versus the people that may be doing it for giggles or maybe I'll just try this and see how I go and maybe it's not my thing and have that type of influence on what goes on between the years as well.
Yeah, I think that's also a really good thing for our business as well, is that we actually don't need to work with everybody. We're not here as a big box churn and burn type business. We're really a boutique firm designed to work with people that genuinely want good results. Yeah. And we're really here as an accountability coach. So we don't give financial advice or we don't give any sort of financial information. We always work in with our members' accountant, financial planner, mortgage broker, solicitor. Yeah. So they're using their own external third parties. All we're here to do is to ask really good questions so that you can actually think about the things that you have to think about. So some people have not thought about tax planning or asset protection. A lot of people, yes, they might be able to go out there, like you said earlier, Luke can do it. I might go and buy 5 properties myself. Correct. But the amount of times we see people go and do that, they buy them all in their own name and they cross-securitize them. They get all sorts of things wrong. And there's all these little things that can be done along the way. And it's the same thing with any elite sport or anything that, a black belt in karate, for example. It's not so much learning how to do your let's use tennis because I don't know much about karate, but tennis, it's not so much hitting the ball, right? You go down and see kids hitting the ball, so they know how to play tennis. An elite tennis player also knows how to hit the ball. It's the little tweaks that you make along the way, how to just angle the racket just a little bit more and how to get your breathing right and your step and all of the things that you need to be aware of, predicting the opponent's move. Correct. All of these things can only be done with experience. And so you might know how to go out there and you speak to your accountant, your mortgage broker, your solicitor. But how do you know that they're the best at what they do? Spot on. If you don't know what questions to ask your advisors, how do you know you're getting the best advice? And this is the stuff that if people go, oh, I'm fine, I want to do it on my own, that's fine. If people want to do that, that's fine. But if they're getting their advice from their accountant, solicitor, mortgage broker, financial planner, how do you know that they're any good? That's right. And the best way that you can do that is by asking them really good questions about their own experience in property, what properties they've got themselves, how long they've held them for, what results they're getting. But often people are a bit scared about asking a professional advisor those questions. Like in any industry, there's good, the bad, and the ugly. And you might find that you've got an accountant that does really good tax returns. They might get you a couple of $1,000s back on your tax every year. But are they the best people to advise you on your property portfolio? Yeah, well said. Well said. I love it. There's plenty of advice that you've got there, and I think your philosophy kind of comes out going, I think you now always said we're boutique and we're not going to work with everyone. There's a real distinction in a business model, but also in the way your client experience is delivered. When
we want this particular type of client, we want to service this type of client, you're the right fit for us, we're the right fit for you. And the outcome, i.e. you winning in business, but them winning in their properties, and the outcome of having the right match with the advisor as well. And I think that's something that doesn't get talked about as much as, the results that some buyer's agents get, or, the next property hotspot as well. So I think it's refreshing to have this conversation, Luke. And I want to thank you very much for you being so generous with your time. Thank you very much for being generous with your insights as well. And that's what we really, really wanted to get out of today's chat. So, mate, I want to say thank you very much. What we are going to do is include links to not only your business, but also to your books as well, and be able to share that. So if you do want to reach out, connect with Luke and the team at the Property Mentors, all the information and details will be there. If you found this episode helpful, if you found it useful, we'd love your feedback. So feel free to give us a comment, give us a review, or drop us a line and say if there's any other topics or questions you want answered. We'd love to help out as well. That's a wrap for another episode of the Australian Property Investment Podcast. We'll see you next time. Take care.